Hello, my name is Melissa Robertson with the Canadian Securities Exchange, and I'm here to welcome you to this special presentation on business risk management for public companies, brought to you by special guests from M&P, Purvis Redmond, and Pilot Law. Over the course of this webinar, we'll be covering areas of risk for audit, insurance, legal, and much, much more. If you have feedback or comments, there will be links at the end. And of course, if you like this video, please feel free to share it. First up, I'd like to introduce Chuck Higgins, Managing Principal at Pilot Law. Providing counsel on commercial and financial matters, he predominantly advises national investment dealers and international mining and energy companies. Chuck has considerable experience with joint ventures, acquisitions, and capital and debt transactions involving resource business.
Thanks, Melissa. My name's, as Melissa mentioned, I'm Chuck Higgins, and my practice focuses on mining and energy companies, so these comments will reflect that focus. So we're talking about legal risks for mining and energy companies. And I used to always tell clients that the legal risk was very small compared to the risks that they have in their businesses. They have geological risks, capital market risks, commodity prices, natural disasters, wars and insurrection. So don't worry so much about legal risk. We'll manage that side, but it's not a big thing to focus on. Go back and get your business running. But that's changed, and there's 3 areas of risk that I'd like to focus on right now. The first one is for anybody who's operating in Canada. Virtually every project you're going to have is going to involve dealing with First Nations and the risk that accompanies that. There's the duty consult in virtually every step of developing a project, and in many cases it amounts to an effective veto. So how do you deal with that risk? Well, in our firm, my colleague Howard Hampton, the former Minister of Natural Resources from Ontario, who's from Fort Frances, has been very effective at dealing with the First Nations. And an example of this is a project that was up right off the Trans-Canada Highway, a gold project that had been stalled for 20 years through the problems with the 2 relevant First Nations and the company that was operating. Now, some new operators came along, and Howard was able to meet with the First Nations, determine, who was in favor of development, and ensure that that their voices were heard within the First Nations, and to break this logjam. And this company's been quite successful and has actually now started developing these projects. But people always ask me, wasn't that such a problem in Canada, having to deal with First Nations everywhere? Well, I'd say that there are also some benefits now, because if your project's going to be dealing with First Nations, they're going to have the labor force that's close enough to your project to help them. In addition, and more recently, the First Nations have access to capital that you may not, which is the First Nations Infrastructure Fund, among other various government initiatives to provide capital to First Nations involved in projects. And perhaps the most important thing is that if you have a First Nations involved as a partner in a project, environmental groups will find it very difficult to raise funds to fight against First Nations. The second area of risk, which is developing, is anybody who's operating outside Canada and the U.S. You're likely working in a civil law system, very different than the legal system we're used to here. I always say that it's form over substance and paperwork rules. And many jurisdictions that you operate on have requirements for local partners, managers, directors, and shareholders. So you can set these things up, but then the question is, what happens if things go bad? And there is a risk of doing that. Your local manager goes rogue. So there are various ways to minimize that risk from a legal perspective, and that to build some protections into your employment and consulting contracts. Looking at your corporate structure to set up, holding corporations in jurisdictions that have more familiar legal systems. But the other thing is to also put in place all documents you need to unwind everything you've done, before you start off on the venture. So that would be undated resignations, retransfers of shares, cancellations of powers of attorney, etc. The third area of risk is litigation risk. And there's two developments in the area of litigation that affects companies and that have been that are relatively recent, and that is contingency fees, where lawyers can only share a share of the proceeds of the spoils of the litigation, and so the companies don't have to pay legal fees up front, and they only pay if they're successful. The other thing is class actions, which provide for numerous plaintiffs that may have smaller cases to come together and sue you successfully. And both of these make it easier to sue companies and to sue their directors. And here's a couple of suggestions. So directors, when you're trying to avoid liability, always seek advice from relevant experts, geological, legal, accounting, where you need them. You won't get second guessed for decisions where you don't agree with the advice you're getting, but you will be second guessed if you don't get that advice. And the other thing I would say, which will tie into our other presentations, is get directors and officers insurance. Even if the chance of litigation, successful litigation against you is low, you still have the benefit of having the insurer defend the action and minimize the costs and the management time there. Also, D&O insurance will clearly let you attract a wider pool of directors and officers than would otherwise be the case. So those are the three areas of legal risk that I'd highlight for our group. Thanks, Melissa. Back to you.
Thanks so much, Chuck. Next, I'd like to introduce Maruf Raza, Senior Vice President, Assurance and National Leader, Public Companies at MNP. Maruf serves as an advisor to public companies and private companies planning on going public through direct initial public offerings or reverse mergers. Regarded as a thought leader on international financial accounting standards, IFRS, Maruf has conducted technical research on IFRS and U.S. accounting standards, including being a part of the CPA Canada's IFRS discussion group and various committees of the Ontario Securities Commission.
Thanks, Melissa. I'm here to talk about a little bit of the risk side as it relates to the audit world, as well as the financial reporting world, particularly as we see it from our purview as auditors to many public companies. So one area we wanted to highlight that we're increasingly seeing a lot of regulator activity is sort of around the e-commerce, digital, and crypto space. Historically, we would have generally looked at, the fact that cash is king. And when when a company receives the cash, that generally provides really good support for a transaction being, validated and complete. Where directionally things are going now is because of this significant reliance that is being placed on third-party service providers. Regulators are increasingly expecting much more detailed governance and controls around that interface with those third-party providers. So if you look at an example like a company that, for example, sells via Amazon, so, fulfilled by Amazon. In many cases, that company may not take, delivery of its inventory. It might all be through Amazon. All the reporting comes from Amazon. All the data comes from Amazon, including the fact that they've made certain sales. So when we look at it from an auditor perspective, again, as we said, historically, we would have looked at, was the cash received? And that's generally a good idea. What regulators are now requesting us as auditors and management teams to do is to look through those service providers. So when you think about typical service providers like Shopify, or if you're, in the restaurant business, using third-party providers like Uber Eats, all of these are third-party providers that we now have to assess, whether or not their information is reliable. So in many cases, these third-party providers would have what we would call SOC reports or system reports, where a third-party auditor has come in and validated that, yes, in fact, the controls at this third party are working. But that's not always the case. And so, when we look at things like cryptocurrency, which are very obvious that there's such a heavy reliance on digital platforms in the crypto industry, and less obvious ones. Where a company has a simple e-commerce website. All of those are relying on these third-party service providers, and so there's a risk from the perspective of these companies, of these third-party providers, that they may not have the adequate documentation to provide to you as public companies. And so that could create challenges from a governance perspective. So it's increasingly important to have these conversations upfront with your third-party service providers to understand what they have, so that when it's time for, whether it's an audit from people like ourselves or from a regulated question, that you have that ability to support that. Moving on to another theme, obviously a lot of discussion, in current society and certainly in the capital markets around ESG. So that's relating to climate change and governance, and we know that that ESG reporting is on the horizon. So when you look at Europe, it is already there, and so a lot of the ESG reporting framework we're already seeing coming in. And we know that in Canada, it is on the horizon. So the reporting standards have been released. What we understand is that for now, most of that disclosure will be driven towards the MD&A versus the financial statements. And that's potentially a good thing, because once it starts feeding into the statements, then of course, you're going to need assurance and audit on that data. And so today, we're obviously not quite there yet in terms of those disclosures, even though we know they're coming. But what we have to watch for right now, and what the securities commissions are watching for in both the statements and in the MD&A, that we're not being overly promotional. So they've provided examples where companies are saying, well, we're going to be net neutral by 2030, or we're going to have a carbon footprint of X by 2027. A lot of those items are not yet substantiated. And so in continuous disclosure reviews, you can expect that if you put out certain types of disclosures that align with that securities commissions are going to ask you to validate how, in fact, that's going to happen between now and 2030. So what we are seeing, certainly with the larger companies, they're actually softening some of those disclosures. Now, when we typically look at many of our venture type companies, I think that we're not as exposed because we've limited the amount of disclosure. What we are seeing is that securities commissions are expecting some type of disclosure. At this point, is relatively high level. Certainly, certain industries, if you're in energy, of course, or mining, there's a greater drive to having more advanced disclosures now. But at this point, it's obviously not required. We should point out that when we look at ESG, one of the big considerations is going to be lending considerations. So when we've spoken to lenders like the banks, they are certainly going to consider ESG policies in their lending decision, whether that's a lend, no lend, or it is relating to what your interest rates might be. All of that will be factored into those discussions. The other piece that's also being forgotten is that in many cases, the footprint from an ESG perspective of a particular issuer or company may be more or less limited, but you also have to look at where the company fits in the supply chain. So, for example, if you're selling into Walmart and Walmart has, the need to disclose certain elements from their ESG reporting, they may look, downstream at some of their suppliers and say, hey, we need some of this information. And if you are going to supply into Walmart, there's a bunch of data elements that need to come in. So the big piece, of course, with ESG is going to be data and how you capture the data that's necessary. So while we do have some time in terms of getting there, it isn't too early to start thinking about that. So one thing that is more immediate, it's not directly ESG, but it is related. There's a bill called S211 that was passed by the Canadian government, and this is an anti-slavery and child labor bill that's been sponsored by the government. And the key item to take away is that there is a report that all public companies need to file by May 31 of 2024. So that's just 5 months away. That actually goes through and provides disclosure around the public company's policies around these matters, and this includes the supply chain. So, as an example, if you're a Canadian public company and you are manufacturing or distributing products, any elements along the supply chain, both Canadian and foreign, you have to basically disclose what you've done to validate that your suppliers are not engaging in these practices. So if you think about a Canadian company that is importing goods from a foreign country, those suppliers are captured. And so at this point, they're not necessarily saying you need to go and audit those suppliers and make sure everything's in line, but they are asking, what is your policy, in terms of the suppliers you're using? And so this is a fairly critical item that is coming up. And as I said, it is mandatory for every public company. And non-compliance in terms of filing the report, it's a $250,000 penalty. So there is some substance here in terms of getting this done. So it's something, if your service providers haven't spoken to you, either your auditors or your law firms, it is something you want to bring up immediately, as there is some effort needed in terms of developing and delivering this report. Finally, I'll mention one area that I think it's not necessarily a direct risk from a company's operational perspective, except for the fact that it is heavily tied in with the compliance of the company. So, as we know, all public companies are required to file annual audited financial statements. In some cases, there are requirements during the year for interim reviews, depending on whether you're doing prospectus offerings. And of course, in order to go public, you have to provide audited financial statements. Generally, that's very much an accepted element. There hasn't really been any issues in the past. What we're finding in the last couple of years, for a number of reasons, some of it is capacity, some of it was COVID, and some of it is relatively new, where we are seeing increased regulator sanctions on firms, as well as firm withdrawals as a result, and for other reasons as well. All of that combined has led to, I think, for the first time in probably 25 years, an inability to always find an auditor. And so we do see issuers struggling sometimes. And in some cases, it's industry specific, like when we talked about crypto earlier. Very few auditors right now are touching crypto because of some of the regulatory hurdles that are associated with it. And in other cases, it's just capacity. So we do see firms, restricting how many clients they can take. Combine that all together. Certainly, if you're doing a new go public deal, it is quite critical to ascertain that you do have auditor availability. I think usually that discussion may have happened further down the line. I think it's one of those discussions that you want to have right up front. And certainly, if you're in the process of changing auditors for whatever reason, it's important to understand what is available out there from an RFP perspective, because I think some companies have gotten a little bit stuck, in that regard. With that, I'll end my presentation. Certainly happy to answer any questions. But with that, Melissa, I'll turn it back to you.
Thank you, Maruf. Please welcome both Mert Guler, Partner, Capital Markets at Purvis Redmond, and Rob Hanson, Eastern Region D&O Leader at Purvis Redmond. Mert's focus is developing PRL's relationships within the Canadian capital markets ecosystem, including CSE and its issuers, securities and M&A lawyers, auditors, broker-dealers, and other regulated financial service providers. He is actively involved in providing risk advice and due diligence for companies looking to go public raise capital, and expand their businesses. He also works with many real estate investors and developers with risk assessment and insurance and advice. Rob is an insurance specialist based in Toronto, Ontario, responsible for the direct oversight of the financial lines portfolio in Eastern Canada. Rob has over 15 years of experience in the financial and executive risk insurance space.
Well, thanks so much, Melissa. I really appreciate it. For our firm, this conversation started in the summer with members of the CSE, just sort of talking about how maybe we could help CSE issuers think about risk assessment, risk identification, risk management, and those types of things. Not in terms of, hey, we're multi-billion-dollar global conglomerates, we're a New York Stock Exchange. No, rather for medium-sized businesses in Canada, publicly traded on the Canadian Securities Exchange. So we started thinking about how to present some very direct and simple advice to executives of CSE issuers. One of the first things we thought about was sort of an analogy with kind of driving risk and risk assessment and risk management as it relates to driving a car. Risk is inherent in everything we do. We want to drive safely and carefully. And insurance is just a sort of safety net, a backstop in the event of something bad happening. But we don't rely on insurance first and foremost. So with that kind of analogy, this is sort of a heat map that we use extensively in the insurance sector and in the risk management sector. I've been involved in some very large projects where this type of risk assessment tool has been used, and it's kind of self-explanatory. Would be around a board or executives sitting around and brainstorming and doing tabletop exercises and talking about what are the kind of things that could possibly affect their business. And throughout my career, in sort of 24 years in insurance, we help our customers identify and prioritize key risks and then manage them. This slide here, this heat map is talking about, of course, identifying and then sort of prioritizing critical risks, most of which are probably outside of your control. In the world of CSE issuers, this could be risks around cannabis legislation and legalization of cannabis legislation, or a lack of decisions and legislation by governments. It could be around big economic things that affect everybody, from COVID or interest rates or anything like that. The very tough situation in the crypto winter and with FTX and things like that have really hurt a lot of businesses in the digital asset sector. These are some things that can be predicted. Some of them cannot be, but thinking about what could go wrong and starting to think about how to plan out scenarios is what a good risk advisor can help you do. My partner, Rob Hanson, is going to talk about how executives focus on decisions, and then I'll continue with some of the things that you can do in your own business.
Awesome. Well, thanks, Mert. Taking a bit of a step back, I mean, really the key risk for public issuers before 2005 was primarily fraud, if you think of Enron and Bre-X, or really complete financial mismanagement, and in the Canadian context, think of Nortel. Not to get too legally here, but in 2005, Bill 198 came. So what Bill 198 does, it amends the Ontario Securities Act, edits statutory provisions that govern public companies here, and really where a much higher standard of disclosure obligations now must be met by Canadian directors and officers, and where the avenue to prosecute public companies under this act has become far more open since. And with these new rules, there became a much larger gray area, I'll call it a gray area, for plaintiff firms and shareholders to bring legal action against public companies here. More specifically, since the act discusses things like acting in good faith, or proper due diligence, or reporting material changes, or taking appropriate action on an issue, this gave plaintiffs and shareholders really the ability to challenge firms on these potential grounds. So what is proper due diligence to one may not actually be proper due diligence to another. What is a material change to one might not actually be a material change to another, and so on. I mean, what's an appropriate action taken by the D's and O's over an issue may be appropriate to one, may not be appropriate to another. And so despite really the good intent of this act to protect shareholders or really any stakeholder through a higher level of public company disclosure standards, it really has opened the door for a lot more subjective, you really should have done this type of lawsuits versus objective, you actually did this type of lawsuits. And as for tips for, I guess, good corporate governance, it was mentioned by, one of my colleagues before, really the advice is to show your work. I was speaking with a very respected defense attorney once where I was hoping to get some good intel on really what the best defense is for a public company who's challenged on their disclosures, for having misrepresented the street. And she said to me, and really not to oversimplify, but it's the same advice that she gets her 12-year-old doing a school project or writing a test. Show your work, show your work, show your work. If you can show your process and really all the due diligence that went into, I'll say, your final answer in school, but really your public disclosure for what we're talking about here, even if the end answer isn't perfect, if you can show your process, that you sought, the right kind of advice along the way, that you really did your diligence, even if that final answer or disclosure is not actually correct, where the grade 12 student can get part marks. I mean, the damages for a public company can be far, far less in a legal situation if you can actually show your work and, prove that you were acting in good faith and really sought the right, financial, legal experts, to help you get to the point where you made that representation to the street.
What comes to my mind is, in terms of governance, is sort of including risks in the decision-making process, the wide array of risks when executives make decisions for the company. And just to use a couple of examples, I'm thinking about the very last box here. There's a lot of things that a company can do just a little bit differently to really reduce risks. That might include using contracts. Like, one of the best things we see to reduce a company's risks are using contracts. Maybe in the mineral exploration field, it's using contracts with your contractors. In the technology sector, it's using contracts with your customers and suppliers, for example. That's one thing that's always recommended. And in mineral exploration, which is a big area for CSE, we see it's really important to consider the health and safety of your employees and expats who may be traveling in different countries, maybe more hazardous regions. Simple things like that, ensuring everybody has workers' comp coverage, simple things like that could really reduce a company's risk. So that's what we talk about. That's an example of embedding risk management related thinking in your decision-making.
Yeah, we'll just kind of wrap up with a couple of case studies. I mean, Mert and I have spent a lot of our careers in the risk management space. And at the end of the day, for a public issuer, which is why we're here today, one of the most, really catastrophic type of events is that there is a catastrophe that may cause bodily injury, property damage, and also where there is a mega stock drop that ensues because of this big event. Even where companies who do have the best risk management procedures, and not to give the insurance plug, but really insurance should be a part of this discussion. You're managing the risk and then options to potentially transfer the risk in these, mega worst case scenario situations. So just a couple of examples here for what we see as the most common for public issuers. Case number one is really the overpromise, underdeliver, allegation that we're seeing. Really, it's when a public company says they're going to do X, they didn't do X, the stock suffered, and investors sued for misrepresentation. This is really the most prevalent with smaller startups and brand new issuers. I think Maruf was mentioning this before as well. Tapering what you're saying you're going to do is extremely important risk mitigation strategy, not shooting for the moon. It's very, very important, to keep that in mind. And we've got the picture of the tightrope here, because essentially you're walking that tightrope. You want to attract investors. You want to sell the story. You want to get, people to invest in you, but, you do not want to overshoot or overpromise what you feel like you actually are going to achieve. And statistics actually show that brand new issuers, kind of year one post, whether it's an RTO or an IPO, but year one of being a public issuer, we see more times than not companies get into hot water in that first year, sort of post or just becoming public. It kind of tapers off as you go, but plaintiff firms are really kind of focusing on you, I'd say, in the first year or two after, becoming public. So if we move on to the second one, I'll call this event-driven litigation. I mean, long are the pre-2005 days that I mentioned before, where it's really just the bankruptcies. And we're seeing what we call event-driven litigation. And better put, this is really when an completely unpredictable event happens and the stock takes a big hit. And then allegations emerge, that the D0s should have done something or should have better disclosed this potential risk to the street before this mega event actually happened. And a few of the best examples that we do see are, one, a big environmental related issue. We've seen, for example, a mine, tailings dam collapse, where a significant stock drop happens after that. We've seen we've seen a lot of safety related issues. And the best public example we like to give is Boeing. I'm sure everyone here has heard of Boeing and the 737 MAX. In that one, there were allegations that, the D's and O's actually misled the street about the safety features of the aircraft. So when the tragedy actually happened, and then the stock dropped, while, it was mega hundreds of millions of dollars for, that went into actually the death of the individuals in the craft, there was about another 150 million that investors were actually able to claim, in a D&O securities class action lawsuit. I'm going into the third case. This kind of does fit in the event-driven bucket, but I do feel like cyber warrants its own separate comment. In that sort of worst case scenario, again, this is where a company suffers a mega cyber breach, which can in and of itself can potentially be financially crippling. From a business interruption standpoint, you're taken down. The cost to notify anyone whose personal information in your system may have been compromised because of the breach. And then you kind of go down the road, gets out in the public, that event has happened, you suffer a mega stock drop, and then investors sue you as well. I know Maruf mentioned before, there's not necessarily hard and fast rules on cyber disclosure in Canada yet, just like on the ESG front, which I know we spent a little bit of time on, but they are coming. The SEC has very strict guidelines about how to disclose your cyber risks, what to do in the event of an actual breach. There are general guidelines in Canada, not necessarily hard and fast rules, but we know it's coming. And again, from a risk management standpoint, it's, be in lockstep with your trusted advisors and have a playbook on what to do in the event, this does happen.
Terrific summary, Rob. And I think these are great cases and examples of litigation and what could go wrong for public executives, and some great risk management advice. Thanks very much, Melissa, and over to you.
Thanks so much for those presentations, everybody. We're going to do a Q&A now with James Black, VP Listings Development, and myself, Melissa Robertson. So we're going to start with you, Mert and Rob. We talk about the tightrope, or a fine line of attracting investors, but not overpromising and under-delivering. So what would you recommend, especially to newer issuers trying to find this balance?
No, thanks, Melissa. An excellent question. And really what we'd recommend here is a very buttoned up investor relations strategy where a CEO and a CFO are in complete lockstep. Where we've seen new issuers get into trouble, if you almost think of the angel and the devil, more times than not, the CEO is the promoter. They are the one trying to attract the investment. They're the ones talking to the street. And then you have the CFO on the other end as well. And for a new issuer, comes with all these disclosure obligations, et cetera, that we talked about before. So especially for new issuers, it's really having a buttoned up investor relations strategy, and where the CEO or the person who is promoting the stock, and speaking to institutional or retail investors on a day-to-day basis to make sure that they're in complete lockstep with, the CFO and the finance team, who is ultimately working with our friend Maruf and actually, involved in, creating the financials that then go out to the street as well. So bit of a simple answer to, just have a good investor relations strategy, but more times than not, we do see for new issuers that angel and the devil. You got the promoter and you got the finance person, and they really got to be on the same page with everything that's, not necessarily that they're just publishing in print, but also saying, to the street when they're doing roadshow, for example. So hope that answers the question, and thanks for that.
I've actually got a question for Chuck. It sort of dovetails off the mineral exploration disclosure in the world of talking about 43-101. So what are some common risks that you see entered into when people make disclosure statements around 43-101 backed disclosures. So I was thinking about the mineral exploration CEO talking about mineral property. Is there anything from a risk perspective that you want to caution these CEOs from entering into, whether it's being too technical with the information or possibly not being technical enough when saying certain things?
Things that I see come up that that people are a bit surprised with. You're an exploration company and you usually have a couple of properties. And it really is important to step back and say what's material and what isn't. Because if you've got a property that's material, you've got 43101 obligations. If it's not material, you can say that isn't. But you can't take the position that a property is not material and then have endless promotional things on your website about it. We've just gone through that with a client that's had to redo a 43101 on a property that was completely inaccessible, had to fly in people by helicopter. It hadn't had a 43101 in 20 years, only because they kept on talking about the benefits of the great benefits of this project on their website. The other issue that I always tell people is if you can find a way to move your operations from BC to Ontario, you'll find much more reasonable regulators. Well, that's a very popular thing to say, but we have moved a number of our clients from BC to Ontario. And the other thing is when you got your QPs, make sure the QPs have expertise in what they're talking about. Because if you get an advanced project, you've got metallurgy and all kinds of other things that someone who's a QP that just does exploration would be totally unqualified to speak about. And the regulators are looking for that. They're looking for the qualification specific, not that just the QP generally, but a QP for the things that they're actually commenting on. So that's sort of the start with things.
Thanks so much. Anyone else have any thoughts on things that you see in the metal space, metals disclosure space that gives you a point of caution or pause when advising clients?
One thing, if I could throw out there, James, is I'm not necessarily specific to mineral exploration, but in general, further to what Chuck and Rob was saying, it's probably a good idea to have your legal counsel, to have Chuck or your other legal advisors take a look at key disclosures, your investor presentation, and for the executives to agree on that tightrope on what you're promising, without guaranteeing anything. But what are we going to promise is probably good to have your legal counsel and your internal board all on the same page there. Those are some key risks that I've learned about today.
Sage advice.
No, good point. I think in the mining space specifically, and if we're talking securities class action, the overpromise, underdeliver, it's timeline to production and companies that just really, really miss. Because usually there's a big stock run up leading to commercial production, and when companies are way off with the timing to actually bring a site online, and or it's the economics end up being way off, it ends up costing you much more than you disclosed. Like that's your easy overpromise, underdeliver right there. You missed the time to bring it to production, and the economics are not what you said they were going to be. One other area is the grade of ore itself. I know there's a lot of people typically involved on the geology side, making sure and verifying that the grade that you say you are digging out of the ground is true. But we have seen some situations where the third-party verification firms aren't. I don't not want to necessarily use the term honest, but may have cut a few corners, and where eventually what got disclosed to the street, wasn't really and truly the grade that was to be expected that this company was going to be pulling out of the ground for the next 10 years. So grade and time to production and missing the economics would undo, site doesn't come online is how I would answer, specifically to mining.
Rob, let me put something positive in here. We seem to be just gloom and doom everywhere. There's risks everywhere and stuff. One thing about 43101, if you can get things into 43101, like production forecasts and those things you can lift right off in your disclosure, and they're generally exempt from faux feed rules, the forward-oriented financial information that the auditors and everybody always frets over. So get that stuff in your 43101, get it right, and then you can use it. You don't have to worry about your auditor telling, no, you can't do that, and we're not verifying it, and it's not going on. So that's just something positive I would throw out there.
Thanks, Chuck. I have a question for Maruf. I think this is especially relevant right now, but what are the potential risk impacts of current market conditions, such as lack of financings on reporting and audits?
Yeah, I think that the primary sort of pervasive one that sort of is important, and it ties into risks and legal elements is whether or not, you have sufficient, funding or resources to make it through the next 12 months. And so typically, if you don't, there's a bunch of required disclosure, almost a buyer beware, that goes into the MD&A and financial statements. So it's incredibly important to warn investors. In some cases, it's fairly obvious. In other cases, it isn't. And so it's important, particularly now, because as we know, most of our, venture type companies, they do go financing to financing. They're in many cases pre-revenue. And so once you turn off the sort of the financing element, or you slow it down based on market conditions, there is no new funding that comes in, and it can lead to challenges, right? And then we know obviously the operational challenges, but from an investor perspective, it is one, relevant, and two, required to actually highlight that, I may not have enough resources to finish the year. Now, that doesn't necessarily mean that, the company's done and away you go. It just means you are just saying that, hey, there's a chance and there's a risk. And we're talking about risks here. That's probably the most pervasive risk you can have, is the ability to continue as a company. So I think that, we expect to see more of that this year, than we've had in the last few. And that's typical. I don't think anybody's going to be surprised, when they see some of these disclosures. And again, it helps protect the company. It helps protect the investors as well as the directors. So it is a good disclosure there. I think when you go a little bit more finite, say more into a more financial statement element, naturally, when you run out of money, there is a discussion that comes up. Are you able to finish your projects? So if you're a mining company, do you have resources to continue to fund the development? And that's the same if you're in R&D or if you're in software. And very well, you might already be in revenue. It's still a conversation that comes up. And the key there is all of that boils into, are the values that you're reporting, are they still correct? So if you're a mining property and you have this value on your balance sheet, well, perhaps it's no longer recoverable. And it might be recoverable again in the future once market conditions turn. But today it isn't. And so there is an expectation that you would see more write-downs, more impairments, and investors would be looking for that. So if you are overstating, what you have, you're pushing the company into a risk position from an investor perspective, because somebody's going to unduly rely on what you've put out there as being overly optimistic. And so it ties into some of the earlier conversations, from Charles and Mert and Rob. So I'll stop there.
Awesome. Thanks, Maruf. And okay, so from the purview of a Canadian listed company, these companies are just operating in Canada. We've talked a lot about domestic risk considerations, but operating internationally, like many of these mining companies you mentioned, or if you're in tech, software, we've even seen in the cannabis space, those who have reached out into different foreign markets. Obviously, your risk profile changes when you start operating outside your own borders. Perhaps, Chuck, you can just start off with this one, but when you start going outside Canada, what are some of the things you advise clients on to first really be aware from a risk perspective? I know it's a broad question, but I think you can probably just narrow down the first things you just really got to think about when you start getting on those planes and going to a foreign country and start operating.
Well, the first thing I would do is tell people, don't do it. Don't go internationally. There's lots of land in North America that's underexplored. You can go there. But if you insist on doing it, look at every step. First of all, talk to your counsel, your Canadian or U.S. counsel, and get hooked up with counsel that really know what they're doing in the local jurisdictions. It's we've got a bar here with some great lawyers and some questionable lawyers and people who don't know what they're doing in various spaces. And internationally, it's the same, if not more so. So try and get some good legal advice before you do it. And think about everything you're doing and think about how you can undo it if things go wrong. Here you can undo things pretty easily. Overseas, it's going to be difficult. I know in Peru, you got a local company in Peru. Well, you got to have one local shareholder, one share held by local people. And if that shareholder goes a bit rogue, they can stop you from having shareholders meetings, stop you from making changes, stopping doing things. You've got to have a way to undo things when they go in there. And also, you're going to have a local partner. It pays to do a bit of due diligence and check them out and see what their previous track record's been with other people. And some clients speak about that from bitter experience. They didn't check out. Obviously, there was information available. They could have seen this local partner has never had a lot of success operating with foreign companies. And so keep your eyes open. It's the risk reward. I mean, there are clearly bigger rewards in some of these places, and with the consummate bigger risk, and you got to work a little harder to minimize that risk.
Yes, and hire the requisite professionals locally to help you manage and navigate that. Over to you, Melissa, for today's final panel question.
Yeah, thank you so much for all of your perspectives today. Thought we'd leave it with risk trends for 2024. So if anyone wants to speak to their thoughts on what's coming up, what these companies should be focused on.
Melissa, I'm happy to start. I mean, I think it was partly, I was touching on it, but I think, in times when, markets are getting a bit drier, the appetite for overly promotional disclosure increases, not decreases. And look, we understand the venture markets. We understand there's a fine line between, being market savvy and pushing forward the company's agenda in a correct way, and then going a bit offside. And I think now, as people maybe perhaps in some companies, they get a bit more desperate, for financing, whatever, there is an element of that. So I think, look, there's some of it which we normally see and expect. We understand mining, we understand pre-revenue companies. I think what we're beginning to see is things like securities commissions really are honing in their continuous disclosure reviews on some of that type of disclosure. I mean, they're always looking, but I think now it's difficult to be overly optimistic when you do see the macroeconomic conditions that are in front of us. So I think that obviously all the good things that are being done should be promoted and promoted well. We just need to be careful that we're not, as an ecosystem, putting forward an image that, everything is fantastic, right? And in some cases it is, right? But in other cases, we do need to recognize some of those elements because everybody is paying attention, and we need to all collectively protect ourselves as well as the people that we work with and that we invest with.
Yeah, I'd like to again try to say something positive for 2024, and that is really since the interest rates started to rise, it's been very difficult for junior companies to get capital, and a lot of them have merged or fallen by the wayside. And I like to think that the ones that have survived and been able to keep the lights on or keep doing things have a lot of opportunities going forward. I'm thinking of companies that are doing copper, the price of gold is cooperating, those things. So I'm cautiously optimistic for 2024. We may have peaked with our interest rates. We may have money starting to come back into the risk market, and the companies that are left are the survivors of a very difficult couple of years.
Maybe if I could throw some thoughts in as well, is like Chuck, maybe to put a little bit of some positive hopes for next year. We've been approached by maybe 4 or 5 companies just in the last sort of 45 days who are thinking about going public, thinking about an RTO, typically on the CSE. Rob and I have been chatting with several, particularly in tech, life science, some sort of new emerging technologies, as well as a slew of exploration and mining sector. And hopefully there's some positive sort of silver linings in the IPO and RTO markets for next year. But what Rob and I are very kind of careful about is, when talking to these leaders, is helping them budget, think a little bit about how the costs as a public company will start to go up. Insurance, we're insurance advisors, insurance will start to go up. And especially if you think about in a US activity, that's when costs go up much faster. So that's just also something to be cognizant of and talk to all the good advisors that you already know.
All right. Well, thanks everyone. And thanks everyone for participating.